All right, let's just dive right into it. Welcome to today's explainer. Look, we all know the surface level mechanics of how shorting works, right? But today, we're taking a really focused analytical look under the hood at the actual structural mechanics of market profits and losses. We're moving way beyond the basic definitions here to decode exactly how long and short strategies generate alpha in real time. So, let's break this down. So how exactly do traders profit when the market drops? I mean, for your average reactive investor, a market drop is basically a cue to panic, or just hold on for dear life. But sophisticated market participants, they don't see it that way at all. They're actually out there actively hunting for these structural drops. They look at downward momentum not as some sort of asset failure, but as a distinct, massive alpha-generating opportunity. To really get market mechanics, we have to look at how these pros position themselves to extract value the second the floor gives out.
All right, moving to section 1, demystifying two-way trading and the concept of the market elevator.
So two-way trading is simply the concept of participating in the market to potentially profit, regardless of whether prices are moving up or down. A lot of retail investors view the market as this escalator, like the general expectation is you just step on and it passively carries you up. But mastering this two-way framework, that requires a mental shift. The market isn't an escalator, it's an elevator. It goes up and it goes down, and you can ride it in either direction. Actually, understanding this completely separates the reactive investors from the proactive market participants. Because at the end of the day, volatility is simply movement, and movement is exactly where profit and loss operate. Let's contrast these mirrored realities for a second. Buying, or going long, locks you into an upward bias. Your absolute expectation is that prices are going to rise, and obviously you win when the asset appreciates. Selling, on the other hand, going short, totally flips the script. You're deliberately weaponizing downward momentum. Your direct expectation is that prices are going to fall. You're actively positioning yourself to capture the structural decay of an asset's value. Pretty cool, right?
Okay, on to Section 2, Tech Stock Walkthrough. We'll look at shorting a market dip. Let's step directly into a practical application here to see exactly how these mechanics lock together. Imagine a major tech stock. It's highly traded, everything's going great. But suddenly, boom, a massive global chip shortage hits their supply chain. They completely miss an earnings call. Market sentiment instantly shifts, and the price just begins to slide. Now, the two-way trader is looking at this exact bottleneck as the perfect mechanism for profit. So here's what you do. Step into that elevator by initiating the short position right as the supply chain news breaks. Basically, you press the down button. And then you wait. As the real-world asset bleeds value because of that chip shortage and, the resulting market panic, the price drives down exactly as you mapped out. Finally, you close the position at the new, lower price. Because you initiated the sell at the high price and then bought it back at the low price, you seamlessly capture the exact difference between those two numbers. You've literally just capitalized on the drop. Which brings us to Section 3, the cost of admission and understanding market friction. Now, before we start thinking this downward ride is completely free, we've got to look at the other side of the mechanics. Entering these trades comes with a bit of a hidden reality, and that's market friction. We call this the bid-ask spread, which is essentially just the small cost of entering the trade. Think of it kind of like a toll booth on the trading floor, or, a casino's built-in house edge. Whether you're buying for an upward climb or shorting a tech dip, you have to pay this toll just to step into the elevator. This friction represents the exact gap between the buying price and the selling price at any given moment. See, there's always a micro difference between what the market is willing to pay and what it's willing to sell for. And this gap, it isn't just theory. It's literally a tax on your conviction. Every single time you enter a trade, long or short, you actually start slightly in the red because of this spread. Calculating this built-in friction beforehand is absolutely a mandatory step before committing capital, because it directly impacts your net profit and loss.
So now that we've really broken down the structural mechanics here, I have to ask, does a market dip look like a crisis to you, or does it look like an opportunity? By truly understanding two-way trading, the mechanics of weaponizing downward momentum, and of course, that ever-present tax of the bid-ask spread, you fundamentally change how you process market behavior. A sea of red on a ticker is no longer just a sign of loss, right? It's a visual representation of downward movement, and movement, with the right strategy, can be systematically captured. Anyway, thank you so much for joining me for this explainer. Keep learning, keep analyzing those mechanics, and I'll catch you in the next one.